All right, let's get right into it. There's been this feeling in the air, right? Whispers, headlines, some really cryptic comments from the top brass in finance. And it all boils down to one huge question. Are U.S. banks secretly, actually, running out of cash? It really all kicked off with this quote. Now, you got to understand, when Jerome Powell, the head of the entire Federal Reserve, says something like this, people pay attention. Gradually tightening sounds pretty calm and boring, but in the world of money, that's the kind of phrase that makes the hair on your neck stand up.
So what's really going on? What are these signals he's talking about? And, the big question, should we be worried? We're going to put on our detective hats for this one and follow the money because we are going to get to the bottom of it. Okay, so our investigation starts with this massive thing that's been happening kind of quietly in the background for the last couple of years. I like to call it the Fed's big squeeze.
Now, the fancy technical term for it is quantitative tightening, or just QT. But forget the jargon. All you need to know is this is basically the Fed hooking up a giant vacuum cleaner to the financial system and sucking money out. The sheer scale of this whole operation is, well, it's pretty mind-blowing.
Just to wrap your head around this, back in mid-2022, the Fed's balance sheet, that's just a wonky term for all the stuff it owns, hit an absolutely astronomical peak of $9 trillion. And today, fast forward to right now, and it's down to around $6.5 trillion.
Yeah, you heard that right. That's a $2.5 trillion drop. That's not a rounding error. That is a colossal amount of money that has just, poof, vanished from the system. So the obvious question is, where did it go?
All right, so the next clue in our little mystery is figuring out exactly where that cash disappeared from. And it turns out the trail leads us straight to the banks.
See, here's how it works. It's a direct link. When the Fed's balance sheet goes down, the cash reserves that all the commercial banks park at the Fed also have to go down. You can think of those reserves as like the main checking account for the entire banking system. And the impact has been huge. Since this whole squeeze began, those bank reserves have plummeted from about $4 trillion down to just $3 trillion. That's a full $1 trillion. Gone. Drained from their number one defense against a financial crisis.
But hold on, $3 trillion still sounds like an insane amount of money, doesn't it? So how do we actually know if that's enough? How can we tell if the system is genuinely starting to feel the pain?
To figure that out, we can't just look at the big numbers. We need a special tool. Let's call it the financial fever thermometer. It's a really clever way to check the health of the system. Because here's the secret. It's not about how much money there is. It's about how much it costs to borrow that money overnight. It's just simple supply and demand. When money is everywhere, it's cheap to borrow. When it gets scarce, the price goes way up. So here's how our thermometer works. It's actually super simple. We just compare two interest rates. The first is the rate the Fed pays banks just to hold their cash there. The second is the actual market rate, what banks charge each other for quick overnight loans. Now, when there's plenty of cash, that market rate is always below the Fed's rate. But when cash gets tight, banks get a little desperate. They start paying more than the Fed's rate just to get their hands on some cash. That's the signal. That's the fever.
Okay, so we have our thermometer. We know exactly what signal to look for. It's time to check the patient's temperature and see what the verdict is.
So what has that financial fever thermometer been reading over the last few weeks? Let's pull up the chart. And there it is. Whoa. Okay, so this chart shows the difference between those two rates. For almost 2 years, you can see the bar was below the zero line. That means cash was plentiful. But look what's happened just recently. For the first time in a long time, that bar has flipped. It's now above the line. The market rate is officially higher than the Fed's rate. The fever is spiking. So the verdict is in. Our thermometer confirms it. The signal is flashing red. This isn't just a theory anymore. There are real, measurable, early-stage signs of stress showing up in the banking system right now. And that brings us right back to where we started. We've found the signals, we know they're real, so what on earth does this mean for the future? Well, these readings from our thermometer, these are the exact signals Jerome Powell was talking about in that quote we saw. You can bet the Fed is watching this chart like a hawk, and it's the number one reason they're now talking out loud about ending their big squeeze, maybe even in the next few weeks. They see the fever, and they're getting ready to act.
So it really looks like this giant experiment, this quantitative tightening, might be coming to an end, all because of the very tensions we just uncovered. But that leaves us with one final, massive question hanging in the air. The squeeze might be ending, but what happens next?